In today's video, we're talking all things taxes. Now, I know that might not sound like the sexiest of topics, but this directly impacts how much money you actually put in your pocket, which I don't know about you, but that's a pretty sexy topic when it comes to the world of running your own business. We're going to look at the three key types of tax you need to be aware of when you start and scale a business. So let's get into it. Welcome to the channel. Today, if you are new here, my name is Ben. I'm the founder of brandbuilderuni.com. I'm a full-time brand builder myself, and I teach on this YouTube channel what I'm learning as I go along this journey. And I hope that today's video helps you on your way to building a brand, building a business that you own, that you can scale, creates freedom in your life, and ultimately you live a life that you love that makes an impact on the world. And one of the big things that comes to all of us when we start a business is this idea of taxes. Now, I spend a lot of my time working with people selling on Amazon, selling on Shopify, in e-commerce, and there are some tax implications for that which are quite unique, but there are also some taxes that really apply generally to all different business types. So no matter what kind of business you're running or want to run, some of this will apply to you. So I'm going to kind of give a bit of an overview. I'm not going to deep dive too much into each specific type of tax. You know, the percentages and when and how and management of that and all of that kind of stuff. Today's lesson is really meant to be more of an overview of each type of tax, what to be aware of, and how you can plan for the future to be as tax efficient as possible. And of course, I have to say this, I am not a tax professional. I'm not a tax advisor. This video should not be seen as tax advice. This is purely just some thoughts from my experiences that may be able to help you on your journey. Okay, let's jump on to the blackboard. The first type of tax that you need to be aware of as a business owner, particularly as an e-commerce seller, is what's called consumption tax. Consumption tax is a tax that is paid by the consumer. The consumer pays this tax. We as business owners, as sellers, we merely collect this tax and then forward it on to the relevant government. Now, this tax is actually based on where you are selling or doing business, where you are delivering your service. Now, there are of course nuances to this, and you should speak to a tax advisor on all of these aspects, but generally speaking, it's where you are selling. Examples of this would be VAT in the UK and Europe. You would have sales tax in America. You would have GST in Canada and Australia. I think those are all of them. I'm probably missing some, but these are the consumption taxes that are levied by the government on the consumer. They pay it, we collect it as business owners, with some exceptions. For instance, in the UK and the EU, there are thresholds that are amounts where if you have a business based in that place, for instance, I have businesses in the UK, meaning that I can trade up to £85,000 of revenue each 12-month period without having to register for VAT. I can if I want to, but I don't have to, and so therefore I wouldn't actually then collect any VAT or give that VAT to the government. As soon as I hit that threshold, I'm legally obliged to register for VAT, meaning that my sale price now has to include, I can either add it on, depending on what platform, what pricing model you're using. If you're selling on Amazon, you can't add VAT on top of your pricing, unfortunately. You just have to absorb that, raise your prices, do whatever you need to do there, but you collect that VAT and then submit it to the government. The same is true in the EU, except the thresholds are a little bit different. Some are higher, some are lower, and also the VAT rates are different. In the UK, you've got a VAT rate of 20%. I think in Germany it's 19%, and they are different throughout Europe. So it definitely is worth checking those. But that's VAT. Sales tax in the USA is definitely cheaper. However, it's broken down rather than by country, by state. And there are some states that charge 0% sales tax, amazing. And there are some that go as high as, I think California is the highest with 7.25%. The biggest issue with sales tax in America is something called Nexus, which is where you have a presence in a state. And if you have a presence in a state, then you need to pay sales tax there. It is a complicated issue, and it isn't something that I would just take lightly. I would look into it, I'd research it and find out what's best for your business. You can get a bunch of help from different places. One of the ones that always gets recommended is TaxJar, a great service that you can check out, taxjar.com, or just Google TaxJar, and it will be able to help you with filing sales taxes in the US. However, if you are an Amazon seller, then Amazon are starting to do do a lot of this automatically for you, which is a great administrative help. They will actually remit this sales tax on your behalf, so you don't really have to do anything. But do look into that, because these rules are always changing. At time of recording, this may change in time. So like I said, I'm just trying to give you an overview of the different types of taxes you do need to be aware of. And then you've got GST in Canada and Australia. Canada, I think, is 5%, Australia 10%, and it's a similar kind of system. The good thing with VAT especially, I know you can actually reclaim a lot of your expenses. So if you are buying goods, if you are selling physical inventory, when you pay import VAT, you can claim that back against any VAT you have to pay that you have received from the customer. Any goods that you are buying in terms of running your business, so new computer, a new camera to take pictures of your products, or services that you're getting a marketing agency and they're charging you VAT, you can run all those expenses against your VAT outlaid to the government, and you can net that out, and so that means that you're not paying as much there, which is definitely helpful. So that is consumption tax, which is based on where you are selling. The second type of tax to be aware of as a business owner, as an e-commerce seller, an Amazon seller, is your corporate income tax. Corporate income tax. And now the good thing about all of these taxes, before you get worried if you're a new seller thinking, oh my gosh, there's so much tax to pay, there actually isn't any tax to pay until you start making money, right? The only reason you are paying tax is because you are making money. And specifically the second one, corporate income tax, the only reason you're going to be paying this tax is because your company is profitable. So rather than being, oh no, there's tax to pay, I would actually celebrate the fact that when the time comes, you have to pay your first amount of corporate income tax, corporation tax as it's called in the UK. That's a day to celebrate, because you are now profitable, baby, and you have a real business. So this one is actually about where you are based. So it's in no regards to where you're selling. You can have a company based in the UK. You could be selling in the US and paying sales tax in the US, and in Australia and paying GST in Australia. But your corporate income tax, or corporation tax as it's called in the UK, you will pay that in the UK. You don't pay that income tax as a business in the US or Australia or in those different places. You pay it in the location of your business. Now, again, depending on where you are in the world, this amount and what time it is, when politicians write their budgets and have to reclaim all of this money that they've printed for, recent global events, shall we say, these numbers may change. But in the UK, at the moment, corporation tax is 19%. So that means that when you file your end of year accounts, which again, in the UK, I speak a lot about the UK because that's where I'm based and that's what I know, you would file your end of year accounts within 10 months of the ending of your final year. So if you open up shop today, you actually won't have to file this, latest, definitely I would recommend being a bit more planned ahead than this, but latest 10 months after the first 12 months, so in 22 months time. So you actually have a long time before this. And if you are running a physical product business, it's usually very unlikely that you're going to have a big profit to post in your first year, because you'll probably be using a cash-based accounting system which accounts for transactions based on when they happen. And that means that in the first year you might make 100,000, 200,000 in sales, but you're probably going to spend a lot on stock, because the more money you're bringing in, the more you're going to ramp up your inventory to keep growing. Now, year 2, year 3, you're going to start posting more profit, and this is going to become more applicable, but it still is good to be aware of it, because there will come a time where you are profitable and you get to the end of the year and you're posted profits, and all of your profits are going to be subject to this 19% tax. Now, this becomes a position where you as a business owner need to be smart about how you can actually decrease your profits without impacting the amount of money that actually impacts your life. And what I mean by that is that you need to make sure that you are not running business expenses through your personal accounts. You need to make sure that you are not paying more tax than you need to. Now, this is not about tax evasion. This is not about avoiding taxes. This is about just being smart with your money. I'm happy to contribute the tax that I owe, but I don't want to pay more tax than I need to, and I'm sure you probably agree. And so being smart with this is a good thing to do. So if you are buying things that is for the use of your business, a computer to be able to run your business, like I mentioned earlier, a camera to be able to take photos, of your products. If you have software subscription, your Amazon account subscription, your Shopify subscription, Helium 10 subscription, for instance, make sure all of those are running through your business so that they get documented as business expenses, so that this profit figure here is not higher than it needs to be. You only want this to be the true element of profit without any business expenditure left out, because that profit amount at the end of the year is going to be taxed 19%. So something to be aware of. And then finally, the third kind of tax you need to be aware of is, of course, personal income tax. Now, if you are getting here to personal income tax as a business owner, then you're doing a great job, because this is what it's all about. You want to get to this point where you can pay yourself a healthy wage out of your business. And so the thing that you need to be aware of here is the most tax efficient way to do this. Again, you want to be able to make sure that you can keep putting funds into your business to grow it and not paying too much tax than you need to. And so just being aware of this stuff is going to greatly help you. And so, I'm going to give you just some thoughts from my end, not tax advice, but just to give you some ideas for the UK. And this is where maybe if you're in the US or in other places, this might be where you can look into how to best do this in your location. But in the UK, what most company directors will do is pay themselves a salary of around £9,000 per year. I know, like living the dream, right? 9k salary a year, you are absolutely rolling in it. Funnily enough, actually £9,000 a year was my first ever salary when I was 18 years old and became an estate agent. But nevertheless, £9,000 a year is the salary that most people would pay themselves as directors of a business, because that is where you're going to keep within your 0% tax allowance, but you're also going to be receiving enough pay to be eligible for a pension later on in life. So that £9,000, and again, your accountant will kind of talk this all through with you. I only know this because I speak with my accountant about this kind of stuff. They know their stuff. I don't. I just do what they tell me to do. But what most business owners will do then, if they have more profit out of the business to be able to pay themselves, is they'll pay themselves in dividends. And the reason they would do that is because dividends are taxed a lot lower than PAYE income. It's a much more tax efficient way to pay yourself. The thing with dividends is you need to be profitable as a company. You can only pay dividends out of profit, so you can't pay yourself these dividends if you aren't making money. The only other thing to be aware of with dividends is they need to be distributed evenly to shareholders. So if you have more than one shareholder in the business, you would need to allocate the dividends and split it according to the shares. So that's something to be aware of. What you can do and what is something to consider are the tax thresholds for dividends. There are limits. You can get sort of a 0% tax allowance on your dividends to begin with, and then there is a threshold at which you will begin to pay a higher tax amount. It roughly works out, at the moment at time of recording, around £37,000 per year, including that first tax-free amount, and also the next tier of low tax dividend amount, which means that all inclusive, if you include both of those amounts together, you can end up paying around 5% income tax on that amount for a salary in the region of £46,000 a year, which is a pretty good salary. If you're at a point where you are wanting to make more money than this, take more money than this out of the business, firstly, well done to you. You're doing a great job. The first thing I would say on that, the most effective way to do that is to have a spouse. Now, don't go out there and say, well, Ben said on YouTube it's tax efficient to get a spouse and just get married to the next person you see for the tax benefits. However, if you run a business with your better half, your other half, like I do, I run a business with my wife, and because of that, she is a 50% shareholder in the company and she is a director of the business, which means I can pay her that $9,000 salary, and I can also pay her those same amount of dividends. So when we have dividends, when we have profit in the business, we pay out dividends, and it gets split between me and her 50%, which takes our allowance, rather than just this 46,000, takes it all the way up to whatever that is, around £92,000 a year that we can have as a family income at around a 5% tax rate. Now, this is, of course, the great benefit of owning a business. People will say, oh, you should pay more tax. And I would say, well, you should live with the stress that I live with, right? And so there's ups and downs to all of this, but this is one of the bigger benefits to owning your own business, so that you can kind of get this kind of income as a family with a low tax percentage. So it really just does impact your income a lot more. This works out at around about £7,500. I haven't done that math from that number just roughly speaking, is around £7,500 per month that you can then use. If you're getting to a point in your business where you are saying, oh well, I want to take more of that out of my business, well, if you're an e-commerce brand owner, I would say you need to be doing sort of 150 to 200k a month before you start looking at more than this number, just because you really want to be plowing money back into the business. If you have higher profit margins or other kind of business where it's a lot higher net margin percentages, then that might be more achievable and you want to pay yourself more than this number here, then of course that's totally okay. But the thing you need to consider is if you're going over this amount, you're going to have to pay a higher dividend tax rate, and it jumps quite significantly higher. So another thing to consider doing is actually over this amount per year is leaving some profit in the business and actually using that money to invest in different aspects of growth in your business, in different assets that can continue to build that income that make this sort of more sustainable over the long term. Far be it from me to tell you how to spend your money and what to do with it, but that is a strategy that could be deployed to keep investing, to keep growing your income, and play the long game there. So a few thoughts about my journey and what I'm learning about tax. Not tax advice, but when you're just starting out, I think it's really helpful to understand first and foremost, the types of tax I need to pay, and secondly, the timings of those taxes and how I can best prepare for those. So consumption tax, in summary, you will need to pay right from hitting the threshold, whether that's VAT threshold in Europe or if you're selling in the US, you'll need to pay that right away, depending on the different states that you have nexus in. But your corporate income tax and your personal income tax will only need to be paid, A, corporate income tax when you're actually making profit, and B, personal income tax when you are paying yourself as the business owner. Now, hopefully that's going to happen sooner rather than later. I'm a big proponent of leaving money in your business wherever possible to keep it growing, because the big opportunity, especially in e-commerce right now, is not necessarily earning a big salary now, but building a big asset for the future. And so I would definitely recommend keeping your eyes focused on that rather than some of the numbers in here. But it does just help you to see what is possible as you grow and scale your business. If you have any questions on this or disagree with anything I've said, please feel free to let me know in the comments. Would love to chat more. Definitely take time to follow me on Twitter, sharing a lot more these days on there. Great community on Twitter. Feels like everyone on Twitter wants everyone else to win, and it's a really good community, so definitely check that out. Other social media links down below, and don't forget the Brand Builder Show, the new podcast is out as well. Lots of great episodes coming up for that, so make sure you subscribe for that, and I'll see you in the next video real soon.